What if the management index actually fails? Is the broader market doomed? The Mag 7, as it's known today, everybody's familiar with that index, but hopefully my clients are even more familiar with the management index, which is actually an index that I came up with before the Mag 7 was created. This is the management index here, and this is the value line average. What I want to point out is the nature of how this has been behaving and what it might mean for the broader market. As strong as it has been, we should not lose sight of the fact that during the bear market from 21 to 22, during that decline, the management index actually underperformed point to point during this bear market. So it was no safe haven. And we know this because there were a number of management stocks that dropped 50 to 70 or 80%. We also know that they've been very strong since the beginning of 2023, outperforming the average stock. And through that period, we've had this sort of sideways basing period. The question is, of course, if these roll over, will that not pull this whole thing into a bear market? Let's take a look at that. Rather than worry about it, let's look at the information. Let's look at the data and see what it says. And then we'll also look at an alternative solution to what would seem to be the obvious outcome should the management index roll over. Here's the acronym here, management index. These are the motor models. This motor model here, basically an average of everything you see here. If these are going to roll over and take the whole world down with them, this is not what they're going to look like before they do it, or at least they're going to look a lot worse than they do right now before we actually have to worry about that. And we'll be able to do that one stock at a time. I want to show you something that's on my mind, and I lived through this. It's something to consider because I think the data as it stands today supports the potential for this outcome. So what we're looking at here is the NASDAQ 100 stocks above the 200-day average, and the S&P 500% stocks above the 200-day average. And we're looking at this is the 2000 peak, so 2000, 2001, 2002. So this is the breadth of the market. Major market tops take place in conjunction with breadth divergences, meaning that the market continues higher at the index level, but stocks inside the index begin to break down. And that's a divergence. We began to see that here. So we already had a lot of stocks in a bear market in the S&P to begin with. And as this was breaking out to new highs up in the 90% range, so almost everything in the NASDAQ was in an uptrend, this peaked right around 55. So there's a lot of bear market activity going on in the S&P 500. This is the type of thing that you would see at a top. So at this stage of the game, we now have pretty good indication that the confidence in these select few stocks, that these are the stocks to own for the future, has grown excessively because now there's basically nothing else participating. Cisco was the largest component. When it peaked, it pulled the NASDAQ down with it, pulled the S&P index down with it. But on the day that Cisco itself peaked, along with the NASDAQ, notice how that's the same day that everything else bottomed. The old economy stocks went into a stealth bull market. So as more and more stocks were going below their 200-day average in the NASDAQ 100, more and more stocks were recovering above their 200-day average. This is a scenario that I actually think has better than insignificant odds of playing out in the future. So if the management index rolls over, I don't give this a small odds of being the probable outcome, that we have this stealth bull market beneath the surface. Now you'll notice that eventually these two breadth indications came into line with each other. We had a recession in 2000 that ended in November of 2001. And of course, we had the tragedy of 9/11 that really affected markets across the globe. And you can clearly see that playing out here in the breadth. But ultimately, we had a one-year bull market, stealth bull market beneath the surface. The main thing is, if we've learned anything in the past 20 years, it is that anything can happen. Follow the data, but when the data says to do something, keep an open mind. So the video you just watched represents a sampling of the research we've produced for clients over the past year on this very important topic. The chart I'm showing you here today is just a current snapshot of this relationship, and I believe our expectations are finally beginning to play out. While the relative trend is still intact for the management index versus the value line, this uptrend has actually been a series of relative performance decelerations, and this is a pretty common sequence of events heading into a relative performance reversal. The most recent bout of underperformance has actually come from the motor index going down, while the average stock has actually gone up. And obviously, if this continues, this will result in a significant reversal in the relative performance of the motor management index. So I believe investors should keep an open mind to this scenario as it's happened before. Several of the management index stocks have already broken down in our models. So to stay current with our latest thinking on this important topic, visit our site today for a 1-month trial of our research. You can click on the link below in the description.